In April 2026, the average American worker received a raise. Their paycheck went up by 3.6%. Yet for the first time since 2022, they actually got poorer. Why? Because prices rose by 3.8%, a tiny gap of 0.2%. But it is the direction of that gap that is everything. That gap is the difference between getting ahead and quietly falling behind. Most people don't even notice it happening. And that's exactly why they stay poor. Money is not wealth. Money is a claimed check on wealth. It is a unit of measurement, like an inch or a kilogram. But unlike an inch, this measurement shrinks. Every year, the government prints more units. More units chasing the same amount of goods means each unit buys less. That is math, plain and simple. Think about it this way. If you have $100 today and inflation is 3%, next year that $100 will only buy $97 worth of goods. You didn't spend it. You didn't lose it. But it's gone. That's the invisible tax. Nobody asks you to pay it, but everybody collects it. Here's what most people don't realize. Your savings account is not a store of value. It is a temporary staging area. There is one rule that governs everything. Your real return equals your stated return minus inflation. If your savings account pays 4% and inflation is 5%, you aren't earning 4%. You are losing 1% per year. Your money is decaying. It is an invisible tax that nobody asks you to pay, but everybody collects. Now imagine something. You're standing in the checkout line. Your cart looks the same as last month. Same items, same store, but the total is $15 higher. You stare at the screen, confused. You didn't buy anything extra. You feel that knot in your stomach, the tightness in your chest. You pay, you leave, and you wonder, what am I doing wrong? The answer is nothing. It's inflation. It's not your fault. You're not failing. The system is stealing from you. Every single day. Here's the uncomfortable truth. The bank isn't paying you to save. They're paying you to stay. And while you stay, your money leaves. Slowly, quietly, but surely. Meet Sarah. She's 32. She saves $500 a month. She feels responsible. She feels safe. She checks her bank balance every morning. It's the first thing she does. It's her security blanket. It makes her feel in control. She's doing everything right, but she doesn't know her money is dying. She blames herself for not saving more. She doesn't realize the game is rigged. Meet David. Same age, same income. He puts that $500 into index funds. He's uncomfortable. He almost sold everything in 2022. The market dropped 20%. He panicked. He opened the app. His finger hovered over the sell button. He was about to quit, but he remembered something his grandfather told him. The market rewards patience. He closed the app. He held on. It was the hardest thing he'd ever done, and it was the smartest. Over 30 years, with an average inflation of 3%, Sarah's safe money loses about 40% of its purchasing power. David's money compounds. He grows wealth. Sarah doesn't. The difference between them isn't luck. It's the single difference between preserving numbers and preserving buying power. Sarah is saving numbers. David is saving value. Here's what the wealthy understand. The real risk is not volatility. The real risk is cash decaying while you watch. And watching it happen is the most expensive thing you can do. Now, the nuance. The official inflation number is an average. Your personal inflation rate might be higher if you rent or lower if you own a home. If you drive a lot, gas prices hit you harder. If you eat out often, food inflation matters more. The headline number is a guide. Your personal number is what matters. More importantly, inflation is not just a number. It's a behavior. When money is cheap, people borrow and spend. More spending drives prices up. It's a self-fulfilling prophecy. This is why you cannot just react to it. You have to anticipate it. You have to stay ahead of it. Here's what nobody tells you. Inflation is not a weather event. It's a system. And if you don't understand the system, you'll always be reacting. But if you do, you can start anticipating. The villain isn't the government. It isn't the Federal Reserve. It isn't the banks. The villain is the belief that cash is safe. The belief that saving money is always smart. The belief that you're doing everything right. That belief is a lie. It's keeping you stuck. It's keeping you watching your purchasing power disappear while you feel responsible. That belief is your enemy, and it's time to fight it. Here's the uncomfortable truth. Safety is the most expensive thing you can buy, and it's sold to you by people who profit from your inaction. Now here's where everything flips. Inflation destroys your cash, but it also destroys your fixed-rate debt. If you have a 3% mortgage and inflation is running at 6%, the bank is effectively paying you to hold that loan. Think about that. The bank is paying you to hold their money. Your payment stays the same, but the dollars you use to pay it are worth less every year. The wealthy aren't just investing to beat inflation. They are borrowing to ride it. Same rule, flipped. That's the inversion. The thing that hurts savers helps borrowers. The thing that destroys cash destroys debt too. And the wealthy understand this. They don't fear inflation. They use it. Here's what the rich know. Inflation isn't just bad. For debtors with fixed rates, it's a wealth-building tailwind. And they've built fortunes riding it. So what do? Step 1. Recognize your savings account is not a store of value. It is a temporary staging area. Move your emergency cash to a high-yield account to minimize the bleeding. You'll still lose to inflation, but you'll lose less. Step 2. Accept that to beat inflation, you must take calculated risk. Real assets, stocks, real estate, commodities are the only proven hedge over the long term. They're not guaranteed, but they're the only game in town. Step 3. If you have fixed-rate debt below the current inflation rate, stop paying it off early. Let inflation pay your bill for you. That's not being irresponsible. That's being smart. But here's the thing. When a market drops 20%, you'll panic. You want to sell. You'll convince yourself that cash is safer. That's your brain. It's wired to avoid pain, not to maximize gain. It's not a moral failure. It's biology. The wealthy don't panic. They've trained themselves to stay calm. They've learned to hold on. The question isn't whether you'll panic. You will. The question is, will you hold anyway? Here's the thing about beating inflation. It doesn't require a miracle. It just requires a shift in perspective. From safety to value, from numbers to buying power. Here's what I want you to do. Right now, open your banking app. Look at your savings account. Look at the interest rate. Now look up the current inflation rate. Subtract. That's your real return. If it's negative, you're losing money. Right now, today. Now ask yourself, am I preserving numbers? Or am I preserving buying power? The answer will tell you everything, and it will tell you what you need to do next. Here's what nobody tells you. You don't need to be a genius to beat inflation. You just need to be honest with yourself. And that's the hardest part. Now imagine the opposite. Imagine your money growing faster than prices. Imagine buying more next year than you can today. Imagine walking through the grocery store without that knot in your stomach. Imagine looking at your receipt and feeling nothing but calm. Imagine the weight lifting off your shoulders. Imagine waking up without the dread of checking your bank account. Imagine freedom. Imagine peace. I started this video by telling you about the grocery store. The moment you got a raise and still fell behind. That's not a bug. It's a feature. The system is designed to quietly drain your purchasing power. But here's what I didn't tell you. The people who understand inflation don't just survive it. They thrive in it. They don't let the system drain them. They use it. They flip it. They turn it into their ally. The question isn't whether you understand inflation. It's whether you let it make you poor or let it make you rich. That choice is yours alone. And it starts with a single question. Am I preserving numbers? Or am I preserving buying power? Answer that honestly, and everything changes. If this resonated, my next video will completely flip your understanding of money. It's called Why Having Debt is So Important. Most people fear debt. They avoid it. They think it's dangerous. But the wealthy see it differently. They use debt as a tool, a wealth-building tool. It's the single biggest cognitive dissonance in personal finance. Watch it. I promise you won't regret it. I'll see you there.